Hello everyone, I'm CA Sonia Kulkarni here. So today we will discuss about repo rates. So you must have heard the term repo, like it is linked to the banking terms. Repo, it means repurchase option or repurchase agreement. Okay, so what is the repo rate? What does it mean? See, repo rate is the rate at which commercial bank borrows money for short term duration from RBI. So, like every single bank, like SBI or maybe HDFC Bank, ICICI Bank, they borrow money from RBI for their financial needs. In case of shortage of um, money, they will borrow short duration funds like overnight to 48 hours. This is the short duration funds from the RBI, and the interest rate at which they borrow is termed as repo rate. So central bank lends money to them at the repo rate. Now, uh, obviously central bank will demand some collateral or security. So what is the collateral they provide here? They provide government bonds, treasury bills, or similar securities as collateral. Okay. Uh, so commercial banks will, financial institutions will pay interest to the RBI as per applicable repo rate. Also, at 10 years and tenure, whatever will be the maturity period after that is over, they can repurchase these bonds from RBI by paying a predetermined price. Okay. So, what is the importance of repo rate? Repo rate, it serves the uh, purpose of RBI to keep check on inflation and economic growth. How? I will tell you. So whatever changes are there in the repo rate that can impact other rates like home loan interest rates or deposit rates like FD rates. Okay. So if there is a change in repo rate, these rates will also get affected. Either they will increase or decrease. So I will tell you for the information, current repo rate is 6.5% and it is remain unchanged. It has been kept unchanged by the RBI monetary policy. Okay. So how does this repo rate works? I will tell you. So it is same like the borrowing and lending concept. Repo rate is just the name, and instead of interest, the name is given as the repo. Okay. So it is nothing like, it is just the interest rate between commercial banks and RBI. Okay. So when financial institutions lend money to public, they also will need to borrow some money during fund shortages or during the financial crunch from RBI. So RBI fulfills this requirement by initiating a repo transaction. That is lending money and charging interest as per existing repo rate. See, when central bank changes the repo rate, it can have impact on the cost of credit for financial companies. This can affect what the lending policies of financial companies. So we will see what if the repo rate is increased or if the repo rate is decreased. So first we'll see impact of repo rate cut, means repo rate is decreased. See, if RBI reduces the repo rate due to drop in liquidity in the country's money market, it impacts economic aspects that increase the flow of money. See, if our commercial banks can borrow from RBI at lower rates, then obviously they will be um, inspired to buy at lower rates, so they will borrow at lower rates, so they will borrow more and more funds from RBI. So that will increase the money supply in market, that will increase the customer spending, that will increase the consumption, so this will stimulate the economic growth. Okay, also they can increase the advantages of decreased interest rate to their customers. That means banks will decrease their home loan interest rates. Okay, so this is the effect. So availability of loans to consumers at cheaper rates, increase in affordability, then increase ticket size of loans from retail consumers, so improving liquidity, significant growth in companies' overall consumption, increased consumption driving the economy towards the growth. So, what did you understood? Repo rate cuts will increase the liquidity and stimulate the economic growth. Okay, but again, if increase in liquidity causes inflation. Okay, so again, we'll check if what will be the impact of increase in repo rates. So, if repo rates are increased, banks are not that much inspired to borrow at higher interest rates. So, there will be less money supply in the market. So, this will decrease the consumption and spending power of the uh, consumers. So, this will control the inflation. Okay, so to control the inflation, RBI will increase the repo rates. Did you understood this? Okay, thank you so much everybody.